All right. We're having some technical difficulties here. Let's see what's wrong. Well, just lost the camera. Come on. There's a little box there with no camera on it. I don't know if it matters. Does it? Now we lost the audio. Is the audio back? Audio's back. Huh. Yeah. That gonna work. Well, audio's good. John says you can see the audio. You're just not seeing me. I don't know what happened. Camera was working just before we started. Lost the camera. All right, I'm not going to worry about it. Let's get started. Because, oh, now I'm losing my voice. What a day. Boy, we're already starting off great. Okay. Let's get started anyway. Let's come in here and I'm going to get me out of the way here. This little thing has got to go somewhere because, well, is that up at the, I got to get it out of this so you can see down here. I'll just shrink this. I want to bring this over so you can see everything. There we go. That's better. Okay. All right. What we're going to do is we're going to do a little precursor. Next week is going to be options week, and we're going to be talking about options. And today I wanted to, yesterday actually, I rolled some options. So what does it mean when you roll an option? Well, it means that the market's moved and you need your option in a different place than you bought it at. Now, options will oftentimes move and you can move them. You move them anytime you want, but it does cost a little bit of money to move an option, but sometimes it's worth it to do it to give yourself some better protection in case the market has moved in your favor or even moved against you and you would like to have a little bit better coverage. So what happens is we have a strategy we call rolling. Now, rolling is a very simple process of saying I want to just move my option. That's all it's doing. And so, a lot of people talk about rolling your option and how big and fancy of, I go to the, restaurant with all their friends. Oh yeah, I was rolling my options today, as if it's some big thing. It's not a big thing. It just means you're selling the one that you bought earlier for either a gain or a loss, and you're buying another one for at a new location. That's all it means. Rolling doesn't, it's not like you can do it manually just by coming in and saying, I want to sell this one and then I want to buy another one. That's all rolling is. So rolling just does it on the same ticket. So it does it at the same time. So you make sure you sell the one and you buy the other one and you match up the spread. That's all it is. And everybody makes a big deal about, I got to roll your option. Just means you're selling the one you got and buying another one. All right. We just do it on the same ticket. So don't get freaked out when people start saying, oh, you got to roll your options. It's just it's a simple process. Okay, so here we go. Let's come in and let's place an options order in here, and we'll show you what we're talking about. Now, the name of the game here is we're going to try and make as much money as we can on our. Primarily, we're working with our underlying stocks, or the in this case, we're going to talk about the yield max funds. All right, so we have a yield max fund, AAP. I think it's what's Apple's? Oh, now I forgot what Apple's code is. We could, I want to do Apple. Let's go see what Apple's yield max fund is. We can do that in several ways. We're going to come over here and we could just go to the website, yield max ETFs. All right. And for those of you who are not aware, this is where you get your single stock ETFs. Single stock ETFs. What the heck is a single stock ETF? That sounds really weird. Well, these guys just trade covered calls for you on your options. And so covered call strategy is if the market's going to drift higher, you're going to get the returns, and they call them distributions. All right. They're distributions, but they give them to you as a dividend. So is it an actual dividend? No, a dividend is actually where the company shares its profits with you. So is it a dividend? No, not really, but that's how they distribute them to you, and that's how they come to you in your accounting system and in your brokerage firm, and that's how the government looks at them. Government, when you go to pay taxes on them, looks at them as if they're a dividend. Are they really dividends? No, they're not dividends. They're distributions. They're distributions because it's in an ETF, a single stock ETF. So an ETF, which is generally a basket of stocks, is turned into a single stock, and then you trade options on it. So that's all they're doing. And then they give you the options premium that they collect when they sell a covered call. So it's a pretty cool system, and that's what gives you these eye-popping returns, right? So when you come in here and look at some of these, oh, they've taken their returns off. Look at this. All right, well, let's come up here and look at the ETFs. So the ETFs, these are the ones that are single stock ETFs, and we like them, but they come with some downside, and so we're trying to protect our downside. All right, the problem is they have what they call NAV decay. So when markets go down, that's what NAV decay is. NAV decay in a single stock futures or in a single stock ETF. I come from the futures world where we used to have single stock futures, but single stock ETFs, and that's why I like them, is because they're kind of what we used to do over in the futures market with single stock futures. But now we've got single stock ETFs. So single stock ETFs are a tool that we can use to help us get these high returns. And that's the whole idea. But when the market goes down, well, just like any market, you lose money. And so we want to stop that. We want to get these high returns without losing money, right? Without having the market go down, go against us. So if we're going to come in here and we're going to, where to go? Apple. Let's find the Apple one. APLY. There it is right there. See it? That's your APLY. Let's click on it. What do they say about it? This is the Yield Max Apple Options Income Strategy ETF. Okay, so that's what we're going to do. We're going to come over here and we're going to pull up Apple, and we're going to pull up AAPL. That was what they said it was, right? So AAPL is your, no, APLY, sorry, APLY. Okay, so we got APLY. There's your NAV decay. See, market's going down. Well, the reason you get NAV decay is because, well, the market's going down. Now, it looks a little bit more exaggerated over here on APLY, but if we come in here and we'll change these chart preferences, and we're going to turn this, we'll bring this way down. Oh, we got to bring it way down. That's as low as we can go right there. So it's actually a matter of scaling. See that? Because this is $13.40. This is $1. So that's AAPY has gone from the very peak up here, which is $14 to $11. So that's your drawdown. But see, when the market goes up, there's no NAV decay because the market's going up. Well, if you come back to Apple, well, the market went up. If we scale it down, it's kind of the same thing, right? Looks just the same. It's all scaling. Oh, the market's going down. Oh, NAV decay. You get NAV decay when the market goes down. All right. So the market's going down, you lose money. That's the way it works. So that's kind of how it works. So what happens is we come in here, and it's called NAV decay because you're in a single stock ETF. So you don't have NAV decay in a stock. So if you come over and look at Apple, you don't say, "Oh, there's NAV decay." Why not? Because it's not an ETF. The word NAV decay is a specific term used in ETFs. Why? Because ETFs generally have more than one stock in them. They have like 50 stocks. And because 25 can be making money and 25 can be losing money, they can't just say, well, it's making money or it's losing money. Well, overall it is, but you've got NAV decay, meaning you got more of the stocks that are losing money that are in the basket than are making money. That's where you get the term NAV decay. That's why it's only attributed to ETFs. Or mutual funds. It's a term that we use for mutual funds and ETFs because they take into consideration more than one stock. If you go out and just look at Apple, when Apple's going down, you say, oh, it's got NAV decay. There's no NAV decay in a single stock. It's just the stock is going down. So if you go over to a single stock ETF and start saying NAV decay, it really kind of makes no sense because there is no NAV decay on a single stock, but that's what they call it. All right. They call it NAV decay because it's an ETF and you got one stock inside the ETF. Just kind of a bunch of, it's neither here nor there. It's just, that's how it works. So as we come in here and we're looking at Apple, and Apple looks like it's coming down, and it makes sense that it's coming down. We got our ABC pattern here, right? ABC, and it's getting ready to come back down, and we anticipate it coming down into this region down in here. Technically speaking, it's not got anything to do with the lesson, but we'll just kind of talk about it just for a second. Everybody loves Apple and thinks that Apple's the greatest thing ever. So everybody's got to have some Apple in their portfolio. So here's what Apple looks like against our map, our Wyckoff accumulation distribution model. So you can see it went through the accumulation stage right over here, just right here, just like a train on rails. Went right up through the uptrend, went through the sideways stuff up here, and then we're coming back down. Okay, making a little ABC pattern. We're going to go through here, and we're coming back down, trying to get this next level. So 1, 2, there's your A, B, C, D right there. A, B, C, D. And we're coming back down into this region here. This is where you're going to want to be a buyer down in here. And when it's down in this region here, this is the accumulation stage for the next rally up. Now, if it goes too far, you have to be careful because notice how this one is this is still higher than this accumulation. So this accumulation is here, the mark goes up, this accumulation here. So this is the shorter term frame, like this is what we call a Darvas box. And in this case, this Darvas box is almost 9-10 months long, right? So now if it comes halfway back down, if it comes all the way back down to this accumulation, all the way down here, like in this drawing, let me show you if I can grab it, get it on the screen. If it comes all the way back down here, well, then we have to worry that, we got another additional downside potential, and it could come up and then flush and go back down again. So go back halfway up about to match this one, and then it would turn and you'd get another ABC back down here, because this would be a bearish version of the accumulation distribution model, right? So that's bearish. This is bullish. So are you bearish on the market? It'll probably do this. If you're bullish on the market, it'll probably do this. So, all right. So that's what we're looking for. It'll probably come down here. So I'm expecting to come down into this region here before we want to be nice buyers. So probably down here, we'll test this low right here. This will probably be an important point for it to come down and test again. If it breaks through, it'll probably come down into this region here, and then we'll probably see a nice little sideways market that will go through accumulation. That would be a great place to buy into Apple. But I want to demonstrate how to roll an option, and I can't demonstrate rolling an option by saying, well, we'll demonstrate rolling options in April 15th. Of course, we'll do that too. But because I want to demonstrate for you today how to roll options, because next week, starting Monday at the university, we're going to be teaching options. So I want to kind of get you excited about options today, because this is my last day teaching here this week on YouTube. Tomorrow, there's no class. So my next class will be on Tuesday evening, or Tuesday morning on YouTube, but Monday evening at the university. So we're going to be teaching at the university on Monday evening, and we're going to start our options class. So for those of you who are able to make it, I'm trying to get you a little bit excited about options and show you some neat stuff we're going to do with options along the lines of what we've just been talking about with the ETFs. All right, the yield max stuff. So what happens is we want to be able to stop. We want to stop the NAV decay. We want to stop the NAV decay, meaning, of course, that we want to make sure that the markets make sure the markets are if they fall, that we don't lose a whole bunch of money. Okay, that's how we're going to do this. So what we do is let's say we want to come in here, and for one reason or another, and today's not the best day to be doing it, but we're going to do it anyway. We're going to come in here. We're going to buy 100 shares. All right. So boom, we just bought 100 shares of Apple, but that's not what we wanted to do. Cancel that. We wanted to actually buy 100 shares of APLY. Now, why would I want APLY instead of Apple itself? So we're going to come in here and we're going to buy 100 shares Are we going to buy 100 shares? Actually, we don't know how many we're going to buy. How many shares of the APLY should we buy? This is the problem. Well, I have $1,000 that I want to invest. Well, the problem with that strategy is that then we can't stop the NAV decay. See right here, this is $1,000. So you'd come in here and say, well, I'm going to put $1,000 in here. I'm going to hit the buy the market. So now you've bought into APLY, and if the market, you're going to start to generate the dividends, right? They're going to come in here and they're going to start selling covered calls on your behalf for you with your money. So they're going to take your $1,000 that you just put in here, and they're going to start running covered calls on it. So what we can do is we can come over to, there's several ways we can do this. It's easy. We'll just come over here to FinViz. I'm going to come over to FinViz because FinViz has the dividends. So we're going to come in here and we're going to go like this. Watch this. We're going to come in here and we're going to pull up APLY. And it tells you what the dividends are right here. See, this pays your dividends. Now, remember, they're not really dividends. They're money that they give you from selling covered calls on your behalf with your money that we just gave them $1,000. And then this is how much they're going to give you, 6 cents. Okay? And then this one here is 6 cents. And then this one here was 9 cents. And then this one here was 5 cents. And then this one here was 17 cents. That's awesome. And this here was 5 cents. And then this one here was 4 cents. Well, let's come over here. We'll just go off the 6 cents. Say average, they give you 6 cents for every share that you own. Now you own because you put $1,000 in there and it's trading at $11. How many shares do you have? Well, you have 85 shares. So what you do is you come in here and you say, you take your $1,000 and you say, I've got $1,000, $1,000. $1,000. We're just going to use our little camera. Oh, you can't see what I'm doing. I got my little calculator out. We could do it on screen. Let's do it that way. So we're going to grab my little calculator. It's a simple calculation. You can just all do this manually, but the reason I'm getting to this is that I've got all this automated for us. I've done the calculators. I've created little mathematical but you have to understand the concept first, and then I'll show you the calculator. All right, so we're going to come in here. We got 85 shares. So we have 85 shares. Let's say that we have $1,000 in here. Well, we know that we have 85 shares. We got $1,000, 85 shares. So we're going to go 85 times 0.06. And that's $5 every week times 52. That would be $265. And then if we divide that by 1,000, equals this times 100 equals 26% annualized return. That's pretty good. You can't complain about 26% annualized return, right? Nobody's going to complain about a 26% annualized return. That's what you're getting if you put $1,000 into APLY. 26% annualized return. You're saying, oh, it only gives you 5 cents. It only gives you 6 cents. Yeah, it gives you that 6 cents every week on every share you have. And the shares right now are only $11. Well, that's not very much money. It's not very much money when you're talking, $1,000 investment. It's $26. But it's actually more than that. But the point is that you're getting 26% annualized return by putting your money into APLY. And that's a small one. APLY doesn't give a high return as some of the others. We got a little table that we can go look at. I'll show you. Okay, we're going to come over here. We're going to go over to Pitt News Magazine /UB. Let's see, it's it's dividend calculator. So we're going to come in here and we're going to say, how much money can I earn if I invest? Let's say, how much do I need to invest? No, how much money can I earn if I put, let's say, $10,000? If I put $10,000 and calculate into, these are the funds, all right? These are the funds that we just looked at, all the yield max funds. So Apple is in here. We can come and find Apple. It's down here somewhere on the list. APLY. It's not alphabetical order because it's by which ones pay the biggest. APLY. There it is right there. So there's your 23% right there, 23.51%. All right. What did our little calculator come out to be? We said 26% based on what it's at now. This says 23%. So 23.51% on average is what this thing's returning. Now, that's APLY. If we come up here a little bit higher, look at some of these at the very top of the list. This one here is Carvana. It produces 125% annualized return. Winter, that's a short position. Fiat, that's a short position. That's AI. Ulti, that's not a single stock. That's a multi-stock. MRNY, that's a stock. This is a touchy one. That's a high one though. Let's go look at it. MRNY. What is MRNY? mRNA. mRNA is the underlying stock. mRNA. Well, you know what that was. That's a COVID shot. COVID shot. You guys can't see me giving myself a shot here on the screen. So the COVID shot. Let's go look at mRNA. So come over here to charts. We come in here. Go mRNA. Whoo, look at that baby. That baby took off and rock and roll. Now, the sad thing is I bought some right here. And then when it turned and fluffed back down, I got rid of it. I missed it by 2 months. And then look at that thing. Took off like a rocket ship. And then I didn't pay attention to it. So I didn't realize it until it was already out here doing this thing. And I'm like, oh my gosh, what the heck is going on? And then I didn't want to get into it when it was peaking like that. And then it drew down. Then I wasn't paying attention to it. And it went back up again like that. What are you going to do, Lan? I don't know. This market is absolutely crazy. Look at that thing. It's gone straight up. You'd think that they created a new virus pill or shot or something. Anyway, this thing's producing like crazy right now. So if we go over and look at the calculation, it's producing a 73% annualized return. 73% annualized return off of the dividends. Now, I got a little dividend calculator that we can go into, but you have to, let's see, where's my little dividend calculator? Watch this. This is really cool. Where is it? We're going to go, here it is. Okay. Is it up? Yeah, right here. Okay. This is Portfolio Matrix. And in Portfolio Matrix, everybody should have Portfolio Matrix. You got to have Portfolio Matrix. This is my portfolio. And this is how I track this is how you have to track all of your dividends. All right. From these single stock ETFs. If you don't have Portfolio Matrix, the reason Portfolio Matrix was created is because the brokerage firm doesn't track them properly. So you have to track them yourself, either in a spreadsheet, which I oftentimes do, as you can see right here. Where's my spreadsheet? Which I give you for free. I give you my spreadsheet. You can have my spreadsheet. This is my spreadsheet. Yeah, this is where's Land's World? January, February, March. Wait, which one is this? Covered calls, business model. This is Gravy Train. Is this one? This is it right here. This is my latest one. Cash cow portfolio. No, this one. All right. I think this is it, right? One of these is. Anyway, this is the spreadsheet. And I give you this spreadsheet. Oh, I moved the spreadsheet. Let me see. This is not the spreadsheet I want to give you. Don't save. I want to give you this spreadsheet. Let me go get it. Hold on a second. I put it in a different folder. So it's actually, I don't use it anymore. That's the reason why I'm Land's portfolio right here. There it is. Okay, my UBI. I had it in a different folder. Okay, this is the one. This is the one I want to show you. This is the one that I kind of don't use this anymore. You can see it's not updated since January. And the reason is because I got Portfolio Matrix now. But if you want this spreadsheet and you don't want to pay for Portfolio Matrix, because it is $25 a month. I mean, after all, you'd rather spend 6 hours a week updating your own spreadsheet than paying $24. Then you can have my spreadsheet and you can do it manually. Okay, there you go. So here it is. So this is how you come through and you have all of you can see that how much money I had invested. This is as of January, because I haven't updated it since January. But I'll go show you over in Portfolio Matrix. So I had invested $653,000. The value, you can see that right here, the market value. This is the only number that the brokerage firm will show you. Okay, this is what the brokerage firm shows you. They show you started with $656,000. They don't even show you that. They just say all you have is 556,000 and you're down 97,000. You're going, what, Len? Why are you showing that to us? You shouldn't be proud of that. You're down 97,000. No, that's the whole point of this whole lesson, because my yield is up 152,000. So even though I am down from 653 to 556, I'm down 97,000 as of January. It's not that bad anymore. It's come back a little bit, but the yield was 152,000. So all of those yield max funds paying out their dividends, they gave me 152,000. So in reality, I'm still up 54,000, or in this case, 42%. I'm up 42% annualized return. That's not bad. You can't complain about that. Anybody going to complain about a 42% annualized return? All right, so that's coming in here, and that's the NAV plus the yield. I'm up $54,000 so far. That was in January. I was up $54,000 in January. Okay. From my invested capital, the value, the gain. So you can do all this. You can have a spreadsheet like this, and you can come in and you can manually enter all these as you buy them and the amount of dividends that they give you, and then you can track all this stuff. And you have to have a subscription to Excel, and you have to have the subscription to Excel that gives you the data feed, because the data feed updates the data. So you're going to be paying $25 a month anyway, whether you do it with Excel and you do it manually, or whether you do it with Portfolio Matrix, which does it for you. Not that I'm trying to sell you Portfolio Matrix, but I'm trying to sell you Portfolio Matrix. You should come and get Portfolio Matrix. It's not my software, but it's my son's software. So he and I invest together, and he was like, Dad, I'm tired of making this spreadsheet. You know what? He says, I'm a good computer programmer. I'll just create us one. I said, all right, that's cool. Well, why don't you create it so that our students can have it too? He said, oh, well, okay, I guess we'll let students sign up for it. But he's like, I'm just developing it right now. That's why he calls it the Founders Edition. So the Founders Edition allows you to come in here and do all kinds of neat stuff that he's working on, where you can come in and you can do the rebalancer, and you can do the set the targeter, and you can come in here. But this is where I wanted to come over here into this, and I wanted to show you, if we pull up MRNY, and we pull that in, you can see that as part of this software program, it shows you, look at this, it's absolutely crazy. The gain is down 39 on MRNY, but the yield is 49, so for a gain of 10%, but that's taking into consideration all the way back to right here. Now, why is that showing? It's showing the gain should be high. The gain should be up. It's 1 year. Let's go back 6 months. Okay, there we go. So we could knock off that first time where we're losing all that money. So now it shot up in the last 6 months. So it's up 24%. So you got a 24% rise in the market. Look at that. That's the rise. That's the gain. See, this is your gain. And then your yield is 42%. 42%. That's pretty good. That's what we calculated, right? So that gives you a 67%. In the last 6 months, that thing's produced a 67% annualized return. And that's a lot of money. A lot of money to me. And this little program does all that calculation for you. You can't get that over here. You go over here to FinViz. It doesn't do all that. It shows you your dividend. That's all it does. It doesn't tell you any of that. APL. It doesn't show you the gain. Nothing. No, nothing here. Well, let's go over to Track and Trade. Well, Track and Trade, although 10 times better than FinViz, it doesn't show you that either. It just shows you what the brokerage firm gives you. It's just a brokerage firm app. So you're looking at mRNA and you're like, well, okay, that's the growth. Where's the dividends? Where's my dividend growth? Sorry, we don't do that. So that's why no program does it. I mean, I've got all of them. Like on my phone, if I go over to my phone, you can see I got all the programs. Here's Fidelity. Fidelity doesn't do it. They don't do it. Nobody does it. Nobody calculates it. Why? Well, I don't know why. They just don't. It's new. I mean, there is that. It's only been around for a couple of years. So maybe that's why. I don't know. They don't. The brokerage firms just don't do it that way. They do it a different way. They calculate things differently. So we're like, well, we need to calculate things our way. And so we created this software program. Actually, I include myself because I helped him, but he did it. It's my son's program. It's called Portfolio Matrix. Just go to portfoliomatrix.com and you can sign up, and then you can have all these tools that you have in there. And here, let me go show you back over to the dashboard. And then it shows you, see, on my spreadsheet, I had all this stuff here, all these numbers, right? Where I'd come in and I'd manually enter all these. So every January, or every month, AMD, my brokerage firm would send me a little text message that says, hey, AMDY just paid you $3,411. Actually, they didn't. They sent me 346. And I put that one in, and then they send me 516, and then I put that one in, and then they sent me 400, and then they sent me 800, and then they sent me 1200. So every time they sent me money, I would add it in to that number right there, and that's how I get that number in January. And then I moved to February, and they'd start sending them to me again because they pay them every week, right? And so every week I'd get my dividend, I'd have to add it into my spreadsheet, and then that would calculate all these numbers up here. So I would get my calendar after a while. You can go back and see my last year's calendar, which would look like this. I have all this stuff in here. You see, I've been doing this for a couple of years now. This is how it looked. So you see all my, like this one here is my NVIDIA. So you can see the money I put into NVIDIA. You can see all of my dividends that came out every month, how much I made every month, and all the totals and all this stuff. Big, nasty spreadsheet. You had to do all this stuff by hand, and I was. Now I don't do any of it because I use Portfolio Matrix. And see, it's all in here. And it just hooks to your brokerage account. So you just attach it to your brokerage account. And it brings all this stuff in. So you can see right now, my UBI portfolio right here. See, this is September, October, November, December, January, February. So we're into March. And so far, this is what I've got. I got Palantir and YQQQ. And that's where my quarter's ending up. My quarter's ending up so far. Well, it's just the first of the quarter. So we're at $36,000 so far this quarter, and I'm up $394,000 this year. That goes back into 2025. So it's the last March, January, February, December, November, October, September, October. You can see if I go back, it goes all the way back to April 2025, because it's going back 12 months. So in the last 12 months, I've made $394,000 in dividends. Now, does that mean I've made $394,000 in cash? No, because we had NAV decay, right? We had some downtrends. So that's what the spreadsheet shows you is over here. It shows you that I had some down, where's Land's World, where we had some, so that would be this total number here. So I had some losses against my dividends. And so that's what this shows you over here. So now if I slide up here, it shows you I have all my totals. So my account balance, it shows my cash, it shows my buying power, it shows my average monthly dividend income, and it shows that my current trading rate is 56%. So I'm up 56%. So it's all done right here for you. And you can see all my dividends. I started reducing the size, my holdings. I had lots and lots in there. I had like all $700,000, $600,000 in there. Now I don't have quite that much into the dividend stuff. I'm doing other stuff with it. I got some buying ones, but you can see, then I got another account in here. This one is my IRA account. And you can see my IRA account is up 66% annualized return this year. And you can see the ones that I'm holding right now is Palantir, Tesla, and Crash. And then you can see all my dividends in here. So all the dividends are built in here. And you can see I'm up 143,000 so far in the last 12 months. So how much this month? This month's just started, March, January, February, March. So we're up $17,000. So that's the quarter. So up $1,300. Last month I made $7,400 in cash in my dividends in February. All right, $7,400. All right, so that's it. That's Portfolio Matrix, and of course, there's, like I said, there's all this other stuff that's over here in this version. That's just your dashboard. So this is how you come in, and it tells you how to invest everything. So it's a really cool program. This is not supposed to be a class on that. I'm just telling you, that's how it works. So let's come over here, and I'm going to show you. You can do all this stuff manually. You don't have to use all these automated systems, because they do cost a little money, because, data's not free and time's not free. So people charge for them, but I'm not charging anything. That's not me. That's my son. He's got that business that we started. And if you want to go and join him, he'll help you. All right. So let's come in here and let's go to mRNA. mRNA, this is through Track and Trade. This is our trading platform. What we want to do, well, this looks like to me it's going to fall, doesn't it to you? Looks like it's going to come down. We don't really want to be a buyer right here, but we want the dividends, right? So let's say we want the dividends. What if we want the dividends? What would we do? We'd come in here and we'd buy some, right? So we come in, let's say 100 shares would be $5,335. Let's say we're going to put $5,000 in there. There you go. That would be 94 shares. We're going to hit buy market. So we just bought that. Now what we've done is we've given YieldMax the money, and they're going to use our $5,000 to trade covered calls. And then they're going to give you the distributions from those covered calls. That's how you get your eye-popping returns, right? But now the problem is here, this market looks like it's going to come tumbling down. We wouldn't really want to buy right here. I mean, I hope you realize that. This is just an example, all right? John says he has Portfolio Matrix. He loves it. Glad to hear. Nice job, John. All right, so we're going to come in here, and what we're going to do is we're going to protect ourselves. We want to protect ourselves to the downside. Now, if I come in here and say, well, I'm just going to buy a put option. Buy a put option. Now, what does a put option do? Let's come out here and go, let's go 127 days. So we're going to buy a put option. We just drop that in there. Now, a put option makes money when a market falls, right? The problem is if we're going to put a put option on Moderna, mRNA, well, we bought mRNA. This isn't going to give us our distributions, is it? So land screwed up. So let's come in here and look at our, well, this is not what we want to do. We can't do this. Let's come in here and delete that. And we also want to close this position because we don't want to really hold a position in mRNA. Close the position. They're not going to trade covered calls for us. So we want to come over here and we're going to go back to our trading tab and we want to go to MRNY. Where is it? I thought I pulled it up. MRNY. All right. This is the one that trades the options. So mRNA is the actual stock itself. And if you want to have the single stock ETF that trades options on mRNA, you put your money into MRNY. So now we come over here, trade. Now we're going to put in, let's see. If we do 100 shares, that's 1,940. That's $2,000. So if we come in here, now let's just say we've got $2,000 and we want to do that. So we buy that. Now, all right, now we'll start getting our what was it? Did we decide it was something like 26%, 26, 23, somewhere around there. 20, let's just say on average 25% annualized return. So that's what we're going to start getting on that money. But the problem is, what happens if the market falls? Well, then we run into the problem that Lan had on his spreadsheet, right? Where we have a situation where we put money in, and then the market fail, so we have losses, right? And then we have our negative number of our losses on the trade, but yet we have a yield that is bigger than their losses, and we still end up with a profit. But the problem is that I started thinking, I'm like, well, you know what? 52% annualized return is a lot of money, but I'm not getting 52% annualized return. Again, if we come back over to Portfolio Matrix, if we come in here and we type in MRNY, right, we're not getting that full 52% return, or in this case, yield where it's 42% return in the last 6 months. We're not getting that full 42%. Well, in the last 6 months, the market went up. So we got a gain of 24%. So we actually got 67%. So here's the problem. Let's go out 1 year because we had a loss on that one. Okay. The gain was 39%. Or negative 39%. So the market actually went down over the last year, down 39%. But we had 50% annualized return. So we're all jumping up and down, running around in circles, slapping ourselves on the back because we got a 49% annualized return on our yield. Yeah, but you have to take into consideration the minus 39% loss. So really, you only made 10%, right? That's what Portfolio Matrix is telling you. Portfolio Matrix says, hey, look, dude, calm down. You're making 50% annualized return, but you had a NAV decay, a drawdown. The market went down. You lost 39%. So you have to subtract your 39% from your 49%. Now, in the last 6 months, we haven't had that. The last 6 months, we made 24%, and we made 42% in our yield, so we have a 67% annualized return. That's awesome if it's doing that. But sometimes you don't buy it then. You buy it now, and it gives you a 39% annualized loss against your great numbers. So I got thinking, you know what? I'm going to dig way back into my history, like 2 years ago, when I used to actually trade instead of just let these guys do all my trading for me. And I started thinking, how can I preserve that 39%? Well, we can preserve that 39% and not have that big 39% loss if we just buy a put option. If we just buy a put option, it should stop the bleeding, right? That 39%, we should be able to reduce that. Now, we're probably not going to be able to reduce it by 100%. We're not going to be able to get all 40%, but it'd be nice if we could cut it in half, right? That would make this be 20%. So if we could just cut it in half, and then of course we're going to do our better technical analysis. We're going to be a little bit smarter about reading our models, right? We're going to be a little bit smarter about trading these things based on our different models. So we're going to read the models, and we're going to say, hey, we don't want to be buying at the top of a trend. We're going to be doing that. We don't want to be doing a little bunch of this kind of crap that we've talked about in previous classes, right? So we're not going to be building upside down pyramids and expecting them to make all kinds of money. So we're not going to do the wrong thing as far as technical analysis goes either. We're going to be wise about our purchases. Right now is not wise about our purchase because this thing definitely looks like it wants to come down. So we're going to come in here and we're going to do it anyway, because we're going to show you an example of putting an option on. That's all we're going to do. We're just going to put up an option on. So I just bought it with MRNY. Why don't I just come down here into MRNY and let's see, each option represents 100 shares. I only have, how many shares do I have? I'm long 104 shares. So I got 104 shares. That's good. So I could come in here and I could just come down to 127 days and I could buy a put option, right? Wrong. Can't buy a put option on the MRNY. You can't do a put option in the yield max fund. Why not? Why can't you just buy a put option right here? Well, because if you look at 127 days left, an option is $360 for 100 shares, but there's nobody trading it. Open interest is 1, volume is 18, with a spread of $640. Do you want to spend $640 on a spread to cover it with a $360 premium? No, nobody's going to trade those options. I don't know who the heck is in there trading those options. Those are ridiculous people. Don't know what they're doing. All right, really got suckered into a $640 spread. Now, you might be able to get that spread down a little bit, but it's still way more than you want to be putting into these things. So what we do is we just come over to MRNA. Now, MRNA, I've not looked at the options on here, so let's look and see. We go to MRNA, which is the same stock, right? MRNY, MRNA, it's the same one. We come over here, and this is where we buy our put option. So now we come in here, and we look at our put options. Now, I'm not real thrilled about this either. Ugh. Nobody's trading options on MRNA. Well, this is going to suck. Look, the spread is $125. So that's a good lesson right there. 152 open interest, 0 on the volume. Even on MRNA, you can't put an option on here because nobody's trading them. You can't do it. I mean, you could try. Some people are doing it. 152 put options. No, that's terrible. The spread is $105. Nasty, nasty. Okay. So that means we're not going to trade it because we can't protect it. Now, if you want to trade it and you don't need an option as protection because you feel like the market's going to rise, then you don't need the protection to the downside. But you're like, Land, why don't I just sell it if I think it's going to fall? Well, then you're not going to get your dividends. And so you're going to go 6 months without any money. So you might as well try and make a little bit of money. So that's why you put your options in. Plus, if you sell it, then you have a taxable event if you're in a tax account. So if you sell them out, well, if you made a bunch of money, like it says in your right here, you just made in the last 6 months, you just made 24% gain, plus you made a 42% yield, you made a 67%. If you sell that thing, of course, you're going to have to pay taxes on this one anyway, because this is your dividends, and you always have to pay taxes on these dividends, right? Because they're not really dividends. They're distributions. So they're taxed at the full rate that you make money at, all right, whatever your tax rate is. And then you're going to, if you sell it, you have to now not only pay it on the 42%, you now have to pay it on the 24%. So you're going to have a 67% gain on your money. You're going to have to pay taxes on all that money. Let's say you had $10,000 in there, $670. You're going to have to pay taxes on. So they're going to take what, 25% of it? Plus your, let's say your state tax, you're going to take another 10%, 5%. You're going to lose 30% of your income, 30% of your $670 just right off the top because you sold them. Well, you're gonna have to pay them off this one, but it's off that 24% you're gonna have to pay taxes on. So you're like, oh, I don't want to pay taxes on 24%. And I got $100,000 in there. That's $6,400. I don't want to lose that. Or $664,000. I don't want to lose it. One of those numbers. So you're like, I don't want to pay taxes on it. So you don't want to sell them. So if you sell them, well, you have to pay taxes on them, right? Taxable event. But if you don't sell them, then you don't have to pay taxes on them. And they're going to keep giving you distributions along the way so you can buy a put option. So unfortunately, there's no put options on mRNA. So let's go do one that is. Let's go over to Tesla. Oh, Tesla. Tesla's got a lot of options on it. So let's go into TSLY. TSLY. This is the look at the market go down. The market's just going. That's not good. So we want to put a put option on it to stop that bleeding. Tesla needs to go up. Tesla's just been going down. Look at this. It's all down, 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 down. That's what we're looking at on over there on Tesla. Just this big down here. It went down here too. It's very exaggerated over here because it's much smaller market. See? So this here. This was the gain, didn't quite go up as far. So it's very exaggerated over here. So this market just goes down, 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 down. Where it was going up was over in here. So you can see right here, it went up. That's the same time frame, right? September. Yeah, that's where it went up. And then it went down. This up here is this up here. Now over here, it went up higher. But now over here, it didn't. That's because they're giving you all that money in profit. But then when the market tanked, it went way down. And that's where it's going to hurt you right there. That's where it's going to hurt you because the market, Tesla went down a lot. I mean, it went all the way down from $487 a share to $400. It went down $87 a share. That's a big percentage. So this one, when it went down, went from $40 a share to $32 a share, about the same percent. That's all that is. So that's your NAV decay, they call it. All right. It's just the market's going down. And then of course they're giving you the money. So they're not reinvesting it. They're not putting it back in. Now you can put it back in, but they don't. They just give it to you. It goes into your cash account. So that's what's happening here. So let's say we want to buy a bunch of this stuff. Let's come in here and do this. Let's go over to trade. And the problem is, how many ever we going to buy? If you just say I've got $500, you're just kind of randomly guessing at how much you're have in there. And so you're going to say, well, I want to put, let's say right here, I'm going to put, let's say we're going to put $10,000 just to keep it easy. So let's just run this up to 10,000. It's 2,500. We got to go all the way up to 10,000. 3, 4, 5, 6, 7, 8, 9. There's 10. We went too far. Okay, so we're bringing it down, We're going to put in exactly $10,000 worth. How many shares is that? In Track and Trade, it does the calculations for you right there. All right, so that's 315 shares. So $10,000. So you say, okay, I want $10,000 worth of this. You're going to go ahead and hit buy market. And then you're going to think to yourself, well, I'm going to be making, over here, TSLY, my gain is negative 24. Over the last year, the yield is 32. So I'm only making 7%. Now, 7% is better than, all the markets are flushing out right now, right? They're all going down. So over the last year, though, Tesla's been struggling. They're down 24%. So Tesla's down 24% over the last year, but you've got yield of 32%. If you didn't have the yield, you'd be down 24% because you lost 24% on the market went down 24%. So you lost 24%. But because you have some yield coming in, you have those covered calls, which made you 32%, you're not actually losing money. Everybody else is losing money, but you're making 7.96%. You're still making an 8% return on your money. And what the hell? Everybody else lost 24%. So that's pretty cool, right? That's pretty cool. You're still making 7% because you had a 32% return on your dividends and you lost 24% in the NAV or in the value, right? We call it the NAV. So the NAV went down 24%. You made 32% for a 7% return while the whole market was going down. You go back over here. Yeah, well, you lost money in if you would have been trading Tesla during that time frame because it went down. Went down a lot. That's a big move. Okay. Now, yeah, it went up first. So you just give them back money you had if you would have bought over here. But what if you bought it up there? Well, you lost a lot of money. But if you'd had the dividends coming in, you wouldn't have lost money. You'd have still made 7% on that drop. That's kind of what that's saying. But what if we could protect that and not lose that money? That's what I'm trying to do here. And that's what we can do with these options. I don't want to lose that 24%. I want to at least keep some of it, half of it, or as much of it as I can. So you can use an option to do it. So that's the whole point that we're trying to do here. Now we can't do it on the mRNA because they didn't have any options. But over here they do. The problem is I got so many options on this one already. We're going to confuse the issue. Let's come in here. And for our demonstration, since this is our demonstration version, I was teaching another class with these. So we can come in here and we'll just, let's go to trade and we'll just exit chart. Exit chart. Say exit. Yeah, just exit all. Exit everything. All right, so we clean that chart off. So now what we're going to do is we're going to come in and we're going to say, I want to put some money into TSLA. Now the problem is, let's just say we're going to come over here and in our TSLY, we bought 315 shares. Now you're like, well, 100 shares of an option covers, or one option covers 100 shares, right? But that's not in Tesla. That's not in Tesla. There's no options in TSLY. We can come and look. 64. Ooh, we don't have we want one around 100. We'll go out a little farther. Look, the spread's $420. The cost of the premium is $830. There's only 15 people traded it. 15 dumb people. All right. We don't trade options on TSLY. There's no options over here. It is an option. I mean, it's trading options on TSLA. So what we want to do is we want to be able to protect ourselves so we don't lose. So that we don't lose that 24%. We don't want to lose this 24%. How are we going to do that? We can't just come over here to track and trade and drop an option in here and say, okay, I'm going to come in here in my options and I'm going to buy a put, right? 162 days out, buy a put, just like that. That would make it easy if you could do that, but you can't. You can't do it because there's no options down here. 420. You can't do that. No way. You can't take that option. So we have to buy the option over on TSLA instead to protect our option, to protect our position on TSLY. So we're going to come in here to TSLA and we're going to buy a put. Now, the problem is if we come in here and buy a put over here, can we get one closer to 100? There's 127. That's better. 98's even good. I will do 127. So we're going to buy a put. So we're going to buy a put, which means we're going to make money when the market goes down. So here's the situation that we run into. I just buy that. Look how much it's going to cost me. $4,287. Well, I only got $10,000 in TSLY. What am I going to do? $4,000 option on Tesla? I can't do that. That doesn't make sense. That's like a battleship options premium protecting a lemonade stand, right? That's like a battleship protecting a lemonade stand. Our little purchase over there on TSLY is a lemonade stand. We only got $10,000 in there. We got 300 shares. This thing here is protecting 100 shares of TSLA, which is trading at $394 a share. $394 a share. That's ridiculous compared to, right, over here, compared to Tesla, which is only trading at $31 a share. So now we have to do the math. Now we have to say, how many shares would my 100 shares of my put option on Tesla cover on my Tesla trade? Now you have to do math. Everybody hates doing math. You have to do a conversion. To convert how much money we're going to have to be spending, how many options we need to cover our trades over in Tesla. Now, the minimum number of options that we can buy in Tesla is 1. So that means we have to have enough money in Tesla to be worthwhile. Otherwise, we're buying way too much insurance. It's like going to unless you think the market's going to crash, you don't need that much insurance, right? And the name of the game is is, I mean, yeah, heck yeah. If you think the market's going to go down, heck, buy a lot of insurance because you're going to get paid a lot of money. But what if the market doesn't go down, right? What if the market doesn't go down? What if it starts to go up from right here and you got a battleship of insurance? Well, you're going to lose a lot of money of that battleship of insurance. You don't need that much insurance to accommodate how much Tesla you own. You only own $10,000 worth of share. You only own 300 shares of Tesla. So you got to do the math. You got to do the conversion. Now, we could sit here and use our little calculators and we could pull it up and we could start doing the math conversion yourself. You can do that. It's very easy. You just divide the number 31 into the number of dollars that there are over there and then multiply it by 100 to get the shares, right? And then times it by the dollar amount you've got in there. And that's how you get the number. But I've got a little calculator for you. I told you I have a little calculator that does this all for you. Watch this. This is really cool. So we're going to come over here, go over to our little calculator, and we're going to say, what is the yield max fund price of Tesla? And look, we're even using Tesla as the example. How much is the yield max fund? So we're going to come back over here and we're going to go to the Tesla. The fund is $31.89. So we're going to come in here and we're going to do $31.89. And the underlying stock price of Tesla, how much is Tesla's trading at? So we go to Tesla. It's trading at $398. $398. And then the cost of one underlying put contract. How much does it cost us to buy that put option? Well, right now it's costing us to do 127 days. It's costing us $4,230. $4,230. $4,230. That's our battleship. All right. Getting ready to blast away all the bad money grubbers. Okay, so the estimated dividend per share on Tesla. So now this is where we have to go over, and we have to go over to, because track and trade doesn't give you dividends. We can go over to Portfolio Matrix, and we can pull it up in here, and we can just go back over to, have we got Tesla? This is Tesla. Yeah, that's it. So it's paying out a rate of 29 distribution 30 cents, 0.296. So we'll just say 30 cents. So we'll come back over here. Oh, not here. Come back over here. Go back over here, 30 cents, or estimated dividends per share, 0.30. Trade duration. The trade duration is the length of time that we're buying on the option, which is 127 days. So we go 127 days, 127. And how often are they going to pay you those dividends? They're going to pay them to you every 7 days. And you hit calculate, and it does all the math for you. And then it even tells you if your trade is going to be profitable or not. So now it comes down here and says, yes, you can do this. It's a profitable hedge. You're going to make a 16% annualized return. So that's not counting that's counting the fact that the market goes down. Now, if the market turns and goes up, you're going to make more than 16%. 16% is if the market goes down, and you have to pay for that, the put option. So you kind of locking in that 16% annualized return. You're like, yeah, but Land, if I don't have it, if I don't have the insurance policy, I could make negative 24%. Go to the 6 months. Let's go to the year. That's 5%, 3%. Oh, wait, that's 1 month, 1 year. Down 20, up 75, 54%. So we're trying to protect that 20% right there, make more of that. And we're buying a put option to do it. See, if you go over the entire year's time frame on Tesla, over the last year, this thing's lost 20, made 75 on the yield for a 54% annualized return. You're like, I don't need any insurance. I just do that. Okay, well, do that. But I kind of like to protect myself against this 20% because I don't know if the market's going to go down anymore. I'm going to protect myself. And so you can be just, you don't have to always have an option on. You can fly free too. You don't have to have an option. If you think the market's going to go up, you wouldn't put an option on. But since it's not, you're going to put the option on. Or if you think the market's going to go down, you're worried the market's going to go down. And you don't have to leave it on all the time either. You can take it right back off. The reason we go out 100 days is because if you don't know and understand the concept of options, they have the theta decay. At the first of the option, the theta decay is very small. So you don't lose very much money of that. You don't have to lose. You're not spending. See, we're putting $4,200 in as an insurance policy. But if we see that the market's turning and going to start to go back up again, we can take that insurance policy off after a week. So we get all that $4,000 back. Maybe we spend a couple $100 is all we had to pay for the insurance during that time frame that we held it. And then this model, you don't have to have all the insurance, right? Makes sense? Hopefully that makes sense. So anyway, this is a profitable hedge. It's going to give you 16.75% annualized return, and during the time frame, it's going to be 5.83%, because you're getting the yield from the dividends are going to pay for the insurance policy, and that's the idea. But because it's a battleship and we have a lemonade stand, we need to increase, because one option covers $44,000 or 1,249 shares. That's how the math works out of TSLY. And we've only got $10,000 in. So one option on TSLA covers $44,000 investment over on TSLY. So if we do that, we're way too much insurance. So what can you do? Well, the only thing you can do if you're going to use a put option to protect yourself to the downside on the underlying stock, which is Tesla, and Tesla is so much bigger, you have to have $44,000 as your purchase price in Tesla. You're like, I don't have $44,000. Well, then you're kind of stuck between a rock and a hard place. The smallest increment is $44,000. So you have to come over here to Tesla and you have to buy $44,000. Now this is 10,000, so we have to buy another. How many shares? 315 is what we have. We need 1,249. So if we come in here at 1,249, so we take our little calculator and we go 1,249 minus, how many do we have? We have 315. We need to buy another 934 shares. So we'll come in here and we'll just go 934. And we're going to say, okay, 934 is $29,000. We're going to hit buy the market. All right, so now we have 1,249 shares, just like it says in our calculator right here, 1,249 shares. That's $44,000 capital investment. And so now we can come in here and we go over to Tesla, and we buy our one option right there. And we say, okay, so now we just come over here and we go to option. I'm going to drop that in there again. So we're going to come in here, going to go to options, and we're going to buy our put right there at the money right there. So that's what we just calculated to do. All right. Now, you don't have to buy the option way up there. You can buy it down here a little ways, right? Which would be a lot less money, $3,300. So if you bought it even down here, right? The problem is that now you have a deductible on your insurance policy. So now the market's going to lose $2,800 before the insurance policy even kicks in. So you can pay it over here or invest it over there, whichever you prefer. But that's going to give you, if you have a more confidence that the market's going to rise than fall, you might want to have a bigger deductible. If you're a good driver, right, you don't buy 100% insurance on your car. You're driving around in a $100,000 car, you want insurance. You want to protect that $100,000 investment. But do you want 100% insurance? Well, I'm a really good driver. I haven't wrecked in 30 years. I haven't had a crash in 30 years. Okay. Well, you're probably a pretty good driver. Chances are you're not going to have a crash. So you don't need to buy 100% insurance. Okay. Well, you get a little bit of a deductible. You bring it down here. That way you're willing to lose, in this case, $3,644 before your insurance kicks in. But at some point, it doesn't make any sense to have insurance. Oh, I'm going to just buy my insurance way down here. Well, you're going to have a big deductible of $7,000. You're going to have insurance of $1,400. And then it's only going to cover you what's down here. And what if it only just comes down there and then goes back up? Well, your insurance didn't do you any good. So at some point, you're paying insurance that's not going to do you any good. And if you can time it, be better at timing it. And if you come over here, you can see the concept is up here. So Land's rambling a little bit, but if you come in here, strategy guide and mechanics, this kind of explains to you the whole process, right? The problem, the lemonade stand, you're the lemonade stand. And then the solution is to buy a battleship to protect the lemonade stand. The problem is we have the notional value, the exchange rate between the two, which is what we just did. So we have the calculation. So it's all right here. The minimum block size. The minimum block size is how many shares the option covers. And this reads your results. It tells you whether the hedge is going to be profitable or not. It'll come in and tell you, no, hedge is too expensive. It won't do it. So then you have your strategic execution. And down here is the one that we're talking about now, which is no hedge, flying free. Advanced strategy. Sometimes if the market is extremely oversold or technical signals align, we may choose to remove the hedge entirely to capture 100% of the yield. This is a high risk, high reward, and should only be done when market conditions justify flying free. So if you think the market's really on a rip tear high, then there's no reason to have insurance. You can drive around without insurance if you're just going to park your car in the garage, right? I mean, you don't need to have, you're not driving around. You don't have insurance on a car that's parked in the garage. Why would you do that? You can suspend it for 6 months if you're not going to drive it. So, but if you think there's a chance this market might come flushing down and you want to buy in, well, you put your insurance policy right at the money or just a drop out like that. That would be 37.47. We could come over to our little calculator and we could make the adjustments, right? We could come back up here and say that our calculator, back to calculator, and we could put in here, we've lost all of our settings because we've done one, but you could put in here a less expensive option. But you realize that by putting in a less expensive option, you got a deductible. So you got a deductible between where the market's currently trading and where it's at, which in this case, it's a little hard to see, $900. That's a $900 deductible by not putting it right at the money. If you put it right at the money, it's going to cover everything from where the option's at, where you got in with your shares, right? It's 100% protection. Now, the thing is, you have to also remember delta. Remember, we talked about the delta cone of probability. So delta, right now, this option is only going to cover, you can see it right there listed, 43, delta 43. So that option is going to only cover 43 shares. So you could do this. You could say, look, land. Now, at the end, by expiration, get rid of that auto chart scale. So by the time you get to expiration out here, it will be up to, the delta will be 100. So it'll be covering 100%. Now, if you look over in the strategy guide, when we do this, it says down here, we roll this thing out after 90 days, okay? The 100-day buy zone. We target put options with approximately 90 to 100 days until expiration. At this range, the daily decay is slow, which is what we want, right? We don't want to chew up our insurance, giving us a cheap protection that holds the value. But here's the key right here, the 60-day roll. We generally do not hold options until expire. Around the 60-day mark, we roll the position, sell the old put, recouping the remaining value, and buy a new 100-day option. All right. This keeps us in the sweet spot of the curve, avoids the rapid value loss happens in the final 30 minutes or the final 30 days of an option. So if you come over here, this one, we come down here, this is where I have our options decay. Because remember, options have a tendency to decay. Where's my little slide that shows that? It's right there. See that? So we're going to buy like a 100-day option out here, and it decays very slowly. So you're not using, I mean, you're getting the insurance, but you're not, the premium is very low. When it comes out here, 30 days, see how fast the decay of the option drops off so fast that you don't want to hold on to your option out there. So we're going to only hold on to it out to about 60 days. And then we're going to roll it at that 30-day point, which means just sell it and buy another one. Okay. So that's what we're going to do over here. So this is, we're going to buy this. So we're going to come in here. Let's go ahead and we'll just buy that. See if it'll give it to us at the market. Yeah. Okay. So it gave it to us at the market. So now we have our little option in there. We have our battleship, which is protecting our 1,249 shares because those are equal. Remember, each option represents 100 shares of the underlying stock. So the underlying stock in this case is Tesla. So it's protecting 100 shares, but it's got a delta of 43. So it's really only protecting 43 shares. So it's protecting half, but it will eventually protect the whole thing. And that's how options work. The delta tells you how many shares it's protecting. So that's 43 shares. So you're like, well, then Lan, I don't really need over here on Tesla. I don't need that many shares. I could actually have half of that and still be protected 100%. You are correct, but only for a little while, maybe the first 30, 60 days, because as the market moves in your favor, this is going to get more and more and more and more money. So you could actually do it that way, because if you're right, then you're going to be protected 50% of your shares. But if the market starts to go up, then you're going to have half the insurance. You're not going to have to pay as much. So it's actually kind of a good idea unless the market tanks real hard. If the market tanks real hard, well, then you're going to want your full shares. All right. But this, you're not going to get your full. The problem is you're not going to get your full if you only go with half the shares, because the delta is at 36. You're not going to get all of your dividends. So your dividends will get cut in half too. So if you go back over to Portfolio Matrix, this number here will get cut in half. And you don't want to do that. You don't want to cut that in half. You could. I mean, it's just math. Do whatever you want. But the calculations work out to be able to cover the entire thing. All right, so that's one. And then this delta will increase. So that's kind of the name of the game. You're only going to get half the shares, half the dividends if you do if you only do like 36 shares, or the equal of 36 shares. So I don't know if that's what you want to do or not, but you could. Again, it's just math. So this is where you're going to get your full dividends, but you have to have 1,249 shares in there to have one option cover you over here like that. So now if the market tanks and goes down, you don't lose any money. Well, it'll be based on delta, but you won't lose any money because it's all calculated out for you and you got your right coverage. Now let's talk about rolling the option. Let's say that the market does come down here. All you'd do is you would sell this one, you liquidate the option, right? And then buy a new option down here. That would be a manual roll, or you can do an automated roll. You can just come in here and say, I want to roll the option. I'm going to roll it down. I'm going to roll it down 3 strikes. And that's all you're doing is, if you see, it's going to sell the one right here and buy the one right here. So if you just come in here, let's just mark it. Oh, let's just, there it is. Let's just mark it in. See if it'll let us mark it in. I don't know if it will. But all it would do is sell this one and buy that one. It's not going to let us market that. We're going to have to bid for it. But that's the name of the game. You come in here, you come down, you just roll your option down. We're going to roll it down 3 strikes. And that you're not going to do that until the market's down there. And it's going to just sell this one and buy that one. And that's all it's going to do. So it's not, to roll an option is not a big deal. All right. So what I did is I'll show you an example of where I actually did roll an option. So we're going to come in here. We're going to cancel this. And we go chart. And I'm going to come over here to Palantir. Now, Palantir, for those of you who are watching, paying attention from previous classes, know that we got into Palantir down here, right? So this is where we went long 200 shares of Palantir. Now, we were just doing this on Palantir itself. We weren't doing the crossover. So this is just a buy on Palantir. And then we had the option right down here. Now, so to roll the option, we just rolled the option, which was sitting right here. And we just rolled it up to this location here to protect ourselves, because we thought, well, maybe it's going to come down and we'll get a pullback. And we wanted to protect our profits. So we locked in that profit with that option. So you can see over here, we have long 200, and then we have 2 options. So 2 options is going to protect 200 shares. So we have 127 days till expiration. So the insurance premium is dropping, but not very much. It's only dropped $295, but yet we're up. If we look at our position on here, chart, we're up $3,000. So our insurance policy costs us roughly $300 to protect ourselves, but we're up $3,200 on the shares. So that's a pretty good insurance policy. It's not bad, right? And it would protect us basically 100% below that red line. Now it's going to be based on delta again. So it's not going to be exactly 100%, but it depends on how long you hold it, because delta will go once it gets to that purple line, it's going to go to 100. So if you wanted perfect insurance, you could get a shorter amount of time and you'd have a higher delta at expiration. Your 100 delta would come sooner. But I like to do it this way with 100 because then the 100 days to expiration, somewhere around 100, because then the theta doesn't decay as much. And if I don't need the insurance, I don't want to pay a whole bunch of insurance. I can, I can cut it short. I've lost $300 on my put option, but I'm up 3,228. Now I lost a little bit on the put option on the previous one, not much. Again, I didn't have much decay. So you buy insurance, you have to subtract that from your from the profits that you've made too. So there is that. You don't want to be overinsured. There's always guys that, buy too much insurance. But I've had situations where I bought lots of insurance and then the market actually flushed and I made more money on the insurance than I lost on the position. So my insurance actually paid me a greater amount of money than I lost on the position, and ended up making money on the insurance on the put option. More money on the put option than I lost on the trade. So it ended up being a profit instead of just to cover my hiney. So that can happen too, And if it's a delta, if you're doing it this way and you're worried because it's only a delta of half of 44%. Right now it's delta of 38%, right? And you're like, oh no, it's only a delta of 38%. If the market fell, well, if the market fell, convexity would draw that up and it would go up. So your delta would increase as that market fell into your favor. So you make more money. That's what delta convexity does. You make more money. Delta increases, so you make more money when the market falls, in this case, because of the premium, and you lose less money because delta goes down as the market starts to rise. So you lose money more slowly. So you make more money more quickly, and you lose money more slowly. So that's pretty nice strategy. I like it. That's why I like options. Now I know some of you are sitting here and you're going like going straight over your head, and you're just like, I don't know, I have any idea what you're doing. Don't worry about it. You just come and get exposed to it. It's something new, and it's not that complicated once you really start doing it. And I'm working on simplifying it. All right, the little calculator over here that we're using. Where is it? This little calculator it's free. You just go get it right now. Back to the calculator. So this little calculator is just out on the web. It's under pitnews.com. So go to pitnews.com/options calculator. Now everybody knows that we're switching the name of Pit News to SFO magazine. So there's your link right there. pitnews.com options calculator index. You don't have to put the index in there. Just pitnews.com has this little calculator in here, and it has the strategy guide, and it explains the whole thing to you. So you've got a little slideshow over here to help you understand what's going on, the concept. So the whole thing is taught right here. All right. Now, the thing is, that you have to go out and do all this manual work. So if you don't mind paying, if you've already got a subscription to like Track and Trade, then we can hook up the data subscription service that comes through Track and Trade. This data that comes here, you're already paying for it. You can hook it up to the calculator, and the calculator will autofill. That's what we're working on. So watch this. Now we can go to SFO magazine, and we can go into the current calculator, which is this one. And now watch, this is the exact same calculator. Now all we do is come to the selector and we say, okay, I want to do Microsoft. We hit load the market data, and it loads everything for you. It calculates all the stuff, does the Microsoft, comes in, shows you the options, tells you whether they're going to be profitable, shows you 3 different options, one at the money, one out of the money, 2 out of the money, tells you how much money you got to have in capital, tells you the number of shares you got to have, and it tells you your annualized return right there. All one fell swoop. You didn't have to go do all that other stuff. You didn't have to go do all the calculation. You didn't have to fill it. You still got the strategy guide that comes in here and explains the strategy guide. You got your interactive lesson that comes in here. It's all here, and the calculator is all automatic. So all you have to do is just select the one you want. So we can come down here. There's AMD. You say load it, and it comes in and says, if you're going to do these options, yep, sure enough, it's going to be profitable for you. You're going to make a 10% annualized return. See how much nicer this is? But you got to have data for it. The problem is you got to have data for it. So here's Coney. Yep, if you did Coney, it'd be profitable at a rate of 7% return. That's that one. If we do this one, it'd be an 11% return. If we did this one, it'd be 16% return. Why would I go with why wouldn't I go with 16%? Why would I go with this one that's only 7? Well, this is bigger insurance. So if you're more likely to have a fall, you want the better insurance. Better insurance costs you more money. This is middle size, so you're like, well, I take it not the best, not the worst. Take it in the middle. Well, that's 11%. If you think the market's really going to go up, there's no reason to buy more expensive insurance. You'd buy this one here. That's 16%. All right, and it's going to change this number here too. You're going to need 21 in capital. This is going to need 22 in capital. This you're going to need 22 in capital. So this is what I'm working on. I'm trying to, but the problem is I can't give it to you for free. All right. Because it costs me money. I have to pay for the data, and the data is expensive. But if you're already paying for the data, because you got track and trade, then I can take the data from your track and trade and pump it into here. And then you don't have to pay. Then the calculator can be free. Not going to be free because this is very valuable. Being able to do this is really cool. All right, you're going to have to pay for it. Part of your Pit News Magazine subscription. So Pit News Magazine which is now SFO Magazine. So you buy SFO Magazine, and then you're going to have access to some of these features. Now, this is the steamroller one. This is the hedge calc. This one's really cool. Watch this one. This one I really like. Watch this one. We'll do one more. I got to go. Actually, I want to do life expectancy. This is one here is the one that tells you when you're going to die. And none of this is done yet. It's not done. I'm just showing you something that's coming to SFO Magazine. So we switched from Pit News Magazine to SFO Magazine. Now we got all these tools that we're building in SFO Magazine. This one tells you when you're going to die. So why do you want to know when you're going to die, Lan? Well, so that you can plan for your retirement. How much money do you need? If I know that I'm going to live to 90 years old, I'm going to need a lot more money than if I'm going to live till 72 years old. So I want to know when I'm going to die. So this comes through and it calculates when you're going to die based on insurance company tables. And then you come in and you fill in all this stuff, like your current age, your biological sex, and then you come in here, relationship status, and your how tall you are, how much you weigh, and it's got like all these questions. Of course, it's not going to let you go through it without having all. And at the end, it tells you when you're going to die, and then it goes through and asks you all these questions about your money. It says how much money do you have, and then it tells you, okay, based on when you're going to die, based on how much money you have, oh, you're good, you can retire today, or oh no, you got a little gap in there. You better, work a little bit on making some more money. That's what it does. It kind of calculates that for you. Kind of cool. I like it. All right. So SFO Magazine, that's the way it works. So in here, I got something for you before we go. Just a couple little things here. First of all.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
And it's the data that comes in from Track and Trade that's going to make all these little calculators work, I think. We might be able to get some of the data from Portfolio Matrix. So if you have Portfolio Matrix, then that might drive some of these. So I might need both, Portfolio Matrix and Track and Trade, and you'll get all the tools because it depends on where you're getting the data and what data we need to run these different calculators. But you can see we're making all kinds of little calculators in here, all kinds of really cool, fun stuff. All right, guys, we're just working on stuff for you, trying to make new tools to help us all make money because it's just what I'm doing. I'm just helping you guys. I'm not here to tell you what to do. I'm just here to tell you what I'm doing and share my excitement with you. All right, guys. One more thing for you. Well, let's listen to Claire. Everybody likes Claire, so we'll listen to Claire give you a little message here.
Hey, everyone. It's Claire. Okay, so before we get into anything else, I need to get something off my chest. And I'm a little nervous saying this out loud, so just stick with me here. You might notice something different. Pit News Magazine has a new name. And yes, this might be my fault. I may have gently, very gently, nudged Mr. Turner into a conversation that turned into another conversation, which somehow turned into a full-on name change. I swear that wasn't the original plan. I was just asking questions. Innocent questions. Like, what if the name told people exactly what they're getting? Totally harmless. So, Pit News Magazine is now SFO Magazine. Stocks, futures, options. That's it. That's what we do. No mystery, no decoding required. Now, full transparency. I'm still a little unsure if this was the right move. I mean, Pit News has been around for a long time. It has history. It has personality. And Mr. Turner definitely gave me that look when I first brought it up. You know the one. The I'm listening but I'm not convinced look. But the more we talked about it, the more it made sense. SFO Magazine tells new readers exactly what they're opening before they even click. No guessing, no assumptions, just clarity. So if you're wondering who to blame, hi, it's me. If you love it, I'll absolutely take credit. If you hate it, I'll be hiding behind my keyboard for a few weeks. Seriously though, we hope you like the new name. Same magazine, same content, same slightly opinionated takes on the markets. Just a cleaner label on the front. Let us know what you think. And thanks for sticking with us. Name change and all.
All right, guys, that's all I got for you today. We're going to let you go, and we will see you. Let's see, today's the last time this week, so we'll see you. Have a good weekend, and on Monday evening at the university. That'll be the first time. We'll see you next week, and then Tuesday morning, we'll have a class here, another lab here on the YouTubes. All right, guys, we'll see you then.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.